Good afternoon, and welcome to Remaking the Economy, Who Controls the Capital. My name's Steve Dubb, and I'm Senior Editor here at Nonprofit Quarterly. This webinar is the fourth in a series of 7 about how civil society can participate in making the U.S. a more democratic economy. Over the next few months, we'll have additional sessions on topics such as leveraging anchor institutions, building policy agendas, and more, and we hope you'll join us for those as well. You'll hear more about them in our upcoming emails. We are fortunate today to be joined by several guests, including Sharanti Gunathilaka, Director of Engagement and Experience at the Village Financial Cooperative, a startup community credit union in Minneapolis, Ignacio Estevan, CEO of Florida Community Loan Fund, and Rodney Foxworth, Executive Director of the Business Alliance for Local Living Economies. We will also be showing a video interview with Cliff Rosenthal, longtime community development credit union leader and author of the new book, Democratizing Finance, Origins of the Community Development Financial Institutions Movement. A few notes before we get started. First, we're very excited to take your questions, and we'll be leaving time at the end of the webinar to address your questions, so please enter any questions you have into the question box in your GoToWebinar control panel. And I will share them with the panelists when we get to that part of the discussion, and we will try to allow at least 20 minutes, maybe more, for your questions. Second, we will be sharing the slides and the recording with everyone who attends via email after the webinar. So please don't feel the need to send chat messages asking if you'll get the slides in the recording. You will. And we will also put them on our webpage within a few days. So be assured that will happen. And last, we are happy to offer this webinar free of charge to all of our community. But of course, it is not free to Nonprofit Quarterly. So if you can, please consider supporting Nonprofit Quarterly today, so that we can continue to bring these brilliant speakers and content to you. Thanks so much for being with us today, and I'll begin with an initial presentation about the series, and then we'll go into the interview, and then you'll hear from the panelists. So, okay. So what I wanted to start with was looking at the change in the financial sector. And if you look back in 1990, the big 4 banks had about 11% of assets in the financial sector. And today, that's up to about 40%. So there's been a very big increase in concentration of assets in the financial sector. So even though we're talking here about community development finance and community-controlled finance, we were not unaware of the larger economy and how that's shifting in the direction of increased financial concentration and control of the capital. Next slide, please. And that being said, one of the sectors we're going to be looking at a lot is community development financial institutions. And essentially, as you'll hear from in the interview with Cliff and also from the panelists, this is an industry that has grown remarkably quickly. So from 13.7 billion in assets in 2003, it's now 185 billion assets. That's more than tenfold growth in 15 years. And specifically in this webinar, we're going to focus on 2 different types of community development financial institutions, one of which is called community development credit unions. Those are insured deposits, and community development loan funds, which are uninsured and therefore have more flexibility in their uses. We'll also talk about impact investing by philanthropy, and I want to signal that another important community finance strategy that's starting to gain momentum is public banks. So these are state-owned banks as exists in North Dakota. Cliff will talk a little bit about them in the interview. Please feel free to ask questions in Q&A. Next slide. And this is where we are in the series. As I mentioned, it's the 4th of 7. Coming up next will be after this one is leveraging eds and meds. So we'll be looking at hospitals, universities, also other forms of place-based, what are often called anchor institutions, such as churches. We'll then move on to looking at public policy that can alter the rules of the game in ways that strengthen communities. And at the end, we're going to look at how do you think about this economic system as a whole. And again, these are the main learning objectives for the series. We're trying to clarify core principles, develop a toolkit, build an understanding of economic ecosystems and how capital, the topic of this webinar, relates to business ownership, which was the previous one, and so forth. Identify ways to decolonize wealth and foster racial equity, highlight points of leverage where we can change things quickly, foster shifts in practice and thinking, and balance the need to focus on getting short-term work done, which all of us have to do in the nonprofit sector, with maintaining a long-term transformative vision. With that, we'll move into the interview with Cliff Rosenthal. Welcome. I'm Steve Debb, Senior Editor of Nonprofit Quarterly. We're here with Cliff Rosenthal, who was former Executive Director of Inclusive, which used to be called the National Federation of Community Development Credit Unions, and is author of the book Democratizing Finance. Cliff, welcome to Nonprofit Quarterly.
Thank you, Steve.
So to begin, I wanted to ask, this webinar is about the ownership of capital, and so why should nonprofits and philanthropy care about who controls capital and finance?
Sure. I think capital and ownership of capital is absolutely fundamental. It's certainly fundamental to the empowerment of any of the communities that we care about. If communities are to have a sense of agency, if they're able to control in any way, shape, or form their own destiny, they have to be able to access capital that they control. The consequences of being constantly renters, so to speak, are that you lack control over your life.
Great, thanks, Cliff. Could you give an example of a community development credit union and how ownership of capital enabled it to influence its community?
One of my favorite examples is a credit union that I helped organize about 30 years ago on the Lower East Side of New York City. This credit union became known as Lower East Side People's Federal Credit Union, arose when the last bank was leaving a low-income neighborhood of leaving approximately 55,000 people in a 100-square-block area without access to basic banking services.
So maybe expand upon that a little bit, Cliff. How did the presence of the credit union impact the Lower East Side?
Well, essentially, people were no longer subject to doing their financial business at second-rate financial institutions, check cashers, and so forth. As well, the community there on the Lower East Side, as well as many in New York City, basically consisted of many low-income renters who had very little chance to acquire a stake in owning a home. What that particular credit union has done is provide financing for people to purchase their apartments, and for these cooperatives, these housing development and finance cooperatives, to essentially sustain themselves and to bring a better life to people. Great.
There was this period during the New Deal and afterwards where the government was, in essence, a partner in developing credit unions. There's a tremendous expansion, right, during the 30s and 40s that your book documents. And then, you had this period where, it sort of, the regulators became more hostile to credit unions. So could you explain, that's kind of the opposite of, often you hear that, in critiques of regulation, how industries take over the regulators. This is almost the reverse. How'd that happen?
That's a really interesting observation and framing of it, Steve. During the 1930s, the problems of poverty were so rampant and so unavoidable that there was much greater public commitment to doing something about it. Here came credit unions, which were self-help institutions that helped people, survive during these very difficult times. And the government thought that it was a suitable role for them to encourage and promote and sustain these institutions. How did it change? Well, for the first 60 or 70 years of the credit union movement in the United States, they were pure cooperatives, which is to say, one member, one vote, you elect the board of directors, you set the policy, and you also bear the risk for the survival of the institution. Credit unions were not federally insured before 1970. 1970, legislation passed that would bring deposit insurance to credit unions. And this was not exactly a deal with the devil, but there were real consequences. They had a share insurance or a deposit insurance fund that they increasingly regarded as their supreme obligation to protect, even if this was at the cost of reining in or constraining credit unions or regulating them much more strictly than they ever had. So there's been that kind of constant tension for the last 50 years.
Great, thanks. That's really interesting. You've also been really involved in the Community Development Financial Institution, or CDFI world, and we'll have a couple people from that on this webinar. But how would you frame both the its tremendous growth as well as the challenges that the movement faces?
So the CDFI movement was gradually gathering steam in the 1980s. I wrote the initial paper for what later became the CDFI Fund back in 1986. We began to develop alliances with the nonprofit revolving loan funds, and around 1990 we decided to take our case to Congress. What basically brought this movement to scale was essentially the kind of unspoken alliance that we had with the first Bill Clinton administration. In 1991, he ran on a platform of, quote, creating a network of 100 community development banks and 1,000 microenterprise funds. And we were able to essentially merge our vision, grown out of the grassroots, with President, the soon-to-be President Clinton's vision. So that fueled what over the course of 20 years has been enormous growth in this field, many, many times over.
What do you see as the challenges the fields face?
I think the challenges are partly challenges of success. One of the arguments that I make in the book is that many successful movements get to the point where the biggest challenge is mission drift.
Great, thanks. So I guess my next question is, if credit unions were sort of the main community finance movement of the 30s and 40s, and CDFI since then, what might come next? I mean, some folks talk about crowdfunding or publicly owned banks, or is it more about building on what we have?
Well, I think that it could be certainly a combination, that they're not mutually exclusive. I think that crowdfunding has considerable potential. In terms of public banks as well, to the degree that this particular approach would be aimed at some of the major infrastructure and institutional investments, I think it could have a lot of promise. I'm reserving judgment a bit in terms of whether it can essentially address some of the basic banking functions that institutions like credit unions, local institutions, neighborhood institutions do address.
Great, thanks. You titled the book "Democratizing Finance," and it, it's certainly a situation where a whole industry, the CDFI industry, has grown up based on those principles, and yet I'd be strained to say that our financial system as a whole in the country is particularly democratic, right?
I have to agree with you there.
So, what would be needed to actually realize the vision, the democratic finance vision that's implicit in your title?
Yeah, I think that while the CDFI field has accomplished a great deal in terms of community development, there's a ways to go still in terms of empowering communities. I think it's reflected in the leadership of some of the institutions, for which may not reflect the diversity of the communities that they serve. So it's a matter of governance. And it's a matter of the participation of the community served in that institution. Not only should the leaders in terms of their gender, their ethnicity, and so forth, reflect that of the community at large, but the community needs a voice. I think also the issue of empowerment is especially important in the case of Native American communities. As you probably know, the history of Native American communities is that vast amounts of the resources have been controlled in trust by the Bureau of Indian Affairs. The fact that CDFIs are a vehicle that is now accessible to those communities, and that those communities can themselves control the use of capital, the aggregation of capital, I think is potentially extremely important. So those are the sorts of models that I look at in terms of sort of the next frontiers in terms of more and better community participation and community ownership in community development financial institutions.
Great. Do we have to look at, I'll call it the mainstream financial system as a whole, and what are there changes that are required there to actually, realize the vision of actually having finance that's democratically accountable?
Well, I think there's certainly a vast amount of room for improvement in terms of the delivery of financial services. We're fighting against an extremely strong current. What you see in the depository world of both banks and credit unions is increasing concentration of assets in a smaller and smaller number of institutions. That concerns me. I don't have a ready answer in terms of how you reverse that or stop that flow, but I think that there should be no doubt that it's a pretty high mountain to climb. I think that the Dodd-Frank law, which included, among the other things, the creation of the Consumer Financial Protection Bureau that I worked at for 2 years, is incredibly important, and it's really essential that that institution be protected against those who would like to dismember it.
Great. Well, Cliff, thanks again for participating in this webinar. Really appreciate your insights, and we'll now return to the rest of the webinar. Thanks so much.
Thank you, Stephen.
Okay, and so first up will be Sharanti from the credit union in Minneapolis.
Thanks, Steve. Hey, y'all. Again, my name is Shranti Ganathilaka here with Village Financial. And our story really starts back in July of 2016 when Philando Castile was murdered by police officers. And at that time in Minnesota, not 6 months prior, Jamar Clark was also murdered by police in Minneapolis. And there was a very long occupation at the 4th Precinct police department. And so when Philando Castile was killed, Malia Connolly, who's the lead of strategy and vision for Village and the founder of Blexit, simply hosted a meeting on the north side of Minneapolis asking folks what were other strategies that we as Black folks on the north side wanted to implement to be able to not have to physically put our bodies on the line to insulate our communities from state-sanctioned violence. And so this idea of where Village came from is really from the grassroots community level. And so we had community members put forward their different ideas in a packed room on big pieces of sticky paper, and people went back around and voted on the initiatives that they thought were the best. And the one with the most votes was a Black-led financial institution. So back then it wasn't a bank or a credit union, but over time when we are looking at how did we want to be able to build community wealth and have community ownership, a credit union was the best fit for all our values. Next slide. So after Blexit was created, which is an activist economic resistance organization here in Minneapolis, who also does different initiatives around Black holiday consumerism, a concept called hotboxing, so the things that happen pre-gentrification in community. The initiative of starting a Black-led credit union was a lot to hold naturally. And so we created the Association for Black Economic Power. And so this this entity is a nonprofit and the development organization, so to speak, that is going to bring the credit union to fruition this upcoming June. So our mission is to transform local communities by equipping Black people with powerful economic tools and resources. And our vision is to see prosperous Black people changing the world for better. Next slide. And so when it comes to the credit union, a lot of the things that we get asked is that we, again, come from grassroots Black liberation organizing. And so a lot of times we hear folks ask, how will this credit union be different than other credit unions? We're very fortunate here in Minnesota to have a plethora of credit unions. However, a new credit union hasn't been established in around 20 years. In the credit union field, there are a lot more credit unions that are consolidating rather than starting up. And so we're really looking at our work as a multi-pronged approach, where we're combining grassroots strategies, cooperative principles and practices, and financial products and services that meet people where they're at. And so a lot of the work that we do is also around grassroots organizing, around storytelling, which is really important in our community when we look at the history of Black communities using credit unions as a mechanism to do the same thing we're trying to do, build community wealth and insulate communities. Here in the Twin Cities, we had a Black-led credit union in the 1920s and in the early 90s as well. And so this is definitely a project that's standing on the shoulders of giants. And so, yeah, so Village Financial, coming from grassroots organizing and Black liberation theory and praxis, is really a community-based project. Even our name was suggested and voted on by community, which is why we have our name. And we're really looking at how can we take concepts around money and people's relationship to money to not only have open space and dialogue and humanity when offering products and services, but really try to figure out what does it look like for our members to be financially well. And this is a picture from a pledging event where we named the credit union. And you'll see that a lot of folks, even though we haven't opened, we have around 1,600 pledges of people ready to move their money into the credit union come this Juneteenth. Thank you.
Okay, thanks, Sharanti. And next up is Ignacio Estevan from Florida Community Loan Fund.
Hi. So I'm very happy to be here. Thank you, Sharanti. I run the Florida Community Loan Fund. I'll explain what that is briefly. I'm delighted for the invitation, Steve. Hearing about credit unions makes me happy because I cut my teeth. I started my career in community development finance at a farm worker-led credit union in Florida. And I consider Cliff Rosenthal not just my former boss, but one of my mentors in life. So delighted to be here and sharing this with the rest of you. So what I want to do is provide you a quick update about quick introduction of what the Florida Community Loan Fund is in my first couple of slides, and then tell you a little bit about why CDFIs are different as a financial institution to other types of financial institutions. So Florida Community Loan Fund is a statewide, we have a federal certification from the CDFI fund, a fund under the U.S. Department of Treasury. We were organized by a group of concerned Floridians that wanted to make sure that capital could flow into low-income communities. Like Sharanti's group, the organizing committee decided on the structure. They looked at various different models and thought that in our case, the best model would be a statewide community development loan fund. We offered flexible financing to community development throughout the state of Florida, and we currently have 6 offices in the state. In broad terms, we lend in 3 general categories. One is housing. On the housing category, our borrowers are both for-profit and nonprofit housing developers. and we really have covered the entire range of the housing spectrum, from financing facilities that provide access to housing for formerly homeless persons, to supportive housing, to affordable rental housing, to single family affordable housing construction. On the economic development part, we do a significant amount of work in helping bring communities up to speed with retail. More specifically, in the last 3 years, we've been working on a project to bring retail healthy food into communities, into food deserts, and we've done some really great work there, and also working with sort of distribution networks of food. And finally, we provide a lot of financing for community facilities throughout the state of Florida, and that includes things like federally qualified healthcare centers, charter schools in low-income communities, nonprofit charter schools in low-income communities. I should clarify that, and other types of activities that provide essential social services for low-income people. A couple of things that are sort of important about our lending. The loan purpose must have a community development or social service purpose. That's sort of our first screen. If it doesn't have that, we don't do the loan. The beneficiaries must be low-income people. So ultimately, it has to be located. It doesn't have to be located necessarily in low-income area, although the vast majority of our financing has been. But the end beneficiaries have to be low-income persons. And finally, it should be clear that our particular loan fund lends to organizations and not individuals. There are some loan funds that specialize in small business lending, and some that even specialize in consumer lending. That is not our case. We are a commercial, primarily a commercial real estate lender. Next slide. So this is a brief slide. In our history, we have financed about $367 million in financing. That includes work through traditional lending, and it also includes work through the New Markets Tax Credit Program, which is one of the newer community and economic development programs out there. It's newer. It's about 14 years old. We have been quite successful in deploying those funds into projects that are aligned with our overall mission. So the vast majority of our borrowers in New Markets Tax Credits are nonprofits. Through our work, we have been able to leverage about $1 billion worth of work in low-income communities, and we track social impact. There to the right, you have a brief summary of the very many metric of social impact that we track. But to date, we have helped finance over 5,300 housing units and 141 facilities totaling over 2.1 million square feet. Our job creation numbers are not necessarily our driver, but we track them. In other words, our first goal is that services are being provided to low-income persons. We also track jobs created, and I think the most important piece of what we do is that about 340,000 Floridians receive social services every year, based on the work that the nonprofits that borrow from us are doing. So we're very proud about that. So in this slide, I'm using this slide to capture how CDFIs are different. Specifically, the Florida Community Loan Fund. We are a mission-driven financial institution. What that means is that we think about what's important in the community before we think about anything else. And really, our decisions should be made based on our mission. We are committed to performance, and that performance is both mission and financial. I think one key element of successful CDFIs to date has been that deep commitment to financial performance and to mission performance. And the third piece is that our drivers as a mission-driven financial institution are very different than the drivers that a conventional financial institution has. There's a whole range of sort of good and bad in the banking industry. We have relationship with most major banks working in the state of Florida, so they have been a part of our growth. They're not all bad, but they ultimately, even though they might have very good CRA, Community Reinvestment Act performance, ultimately they are for-profit entities that are thinking about the bottom line. And we don't have to do that. We think about financial performance, but it's not about the bottom line for us. That means that we can take additional risk, and we can be more patient with our capital than a traditional financial institution can. So this is 4 elements of where I think the CDFI industry will be going in the next 5 to 10 years. Next. First, it's scale and coverage, right? So as a nonprofit, the Florida Community Loan Fund is about $70 million in assets. That sounds big. It is a relatively big nonprofit. As a financial institution, we are tiny. A $70 million bank is very small. In the loan fund side, you have a few loan funds nationally that are approaching $500 million, some that are a little bigger than that. But still, that is very small relative to what the need is. So it's not just scale. So that scale to me is sort of growing our institutions to the point where we can be meeting all of the needs. The other one is coverage. We have a growing and strong patchwork of CDFIs that are meeting different needs in different communities, but not all CDFIs are good in every community. And one of the goals that we have as an industry is to make sure that in every community in America, there is the right mixture of CDFIs that can achieve that scale and coverage. This is paving the way for greater capital flows is essentially the industry's attempt to bring capital from different sources. To date, the CDFI industry, especially the loan fund piece of the CDFI industry, has grown through bank capital, and we think we want to go to the capital markets next. One of the key elements of CDFIs has been, one of our mottos of the CDFI industry has been capital for political, social, and economic justice. And I think we're going to continue to do that. And finally, next, hybrid CDFIs. So CDFIs in general fall into 4 different categories: loan funds, credit unions, banks, and venture funds. Typically, we're sort of siloed. We're either one or the other. I think in the future, for a variety of reasons that would take me a lot longer than I have to explain, you'll see CDFIs that are more than one type of CDFI under the same umbrella. You have examples of that in North Carolina and Mississippi, but besides that, there are not too many examples. So I'll stop there, and thank you, Steve.
Thank you, Ignacio. And next but not least, Rodney Foxworth from Business Alliance for Local Living Economies.
Well, thanks, Steve, and I hope everyone can hear me well. I'm really excited to be able to participate in this conversation. Thanks for having us. I just really quickly, Steve did a phenomenal job of really articulating why this is a really important conversation, and really reflects a bit of the shift that we've experienced at the Business Alliance in terms of our focus, which has really been over the last few years, more particularly around racial equity and how that impacts wealth inequality. And that wasn't always the case, as Steve knows well. And Nonprofit Quarterly did a wonderful piece last year really highlighting some of the shifts that have happened at the Business Alliance for Local Living Economies. But I wanted to make sure that, because I know the audience and those involved in the conversation, not everyone is engaged in the financial aspects of community wealth building. And so really want to highlight the true importance of why nonprofits in particular have such an important role to advance community wealth in the U.S. in particular. And just to situate it again, in the U.S., the wealthiest 1% own 40% of the country's wealth. When we look at racial inequality, we know that if things do not change, there's a possibility, according to research, that by 2053, median household wealth for African Americans could drop to zero, while white household wealth increases to 137,000. And so we've got these really important things to grapple with, and the nonprofit sector has a significant role in advancing change. To speak a little bit more poignantly about the Business Alliance for Local Living Economies, otherwise known as BALI, we've been around for about 18 years, and really our focus is on connecting leaders that are working really deeply in communities to advance economic change, principally through new models of entrepreneurship and business development that really focus on advancing the interests of communities. Then also spreading solutions, new models, and I shouldn't say new models, but non-mainstream models like cooperative ownership and other ways of looking at how you can advance equitable outcomes for people. And then driving new investment into these types of models. So next slide. To be more concrete, we currently have 101 fellows across the U.S. and Canada that do this sort of work. We also have a foundation circle where we work with 45 foundations across the U.S. and Canada to work with them to invest in more equitable ways in their communities. And so I want to take a moment to really speak about a few of the leaders in our network. Rising Tide Capital, led by one of our fellows, Mortar, also led by one of our fellows, then also Baltimore Community Foundation, which is a participant in our Foundation Circle program. The really important thing, as I speak about Rising Tide Capital, which is based in New Jersey, they're Rising Tide Capital, and actually when the founders developed the idea for the institution years ago, they initially were going to do micro lending as a way to uplift the fortunes of low wealth entrepreneurs in New Jersey. However, what they determined was that one of the principal barriers for low wealth entrepreneurs in communities that have been deeply impacted by historical and contemporary inequities was really around building the capacity as entrepreneurs to have the social access, to really have the training and supports to build viable businesses. And so one of the reasons I wanted to speak about, or at least highlight the work of Rising Tide Capital, is because for nonprofits that are less comfortable or not experienced or engaged around the financial side of things, Rising Tide Capital demonstrates that it's really important, demonstrates the important role of nonprofits as potentially able to equip entrepreneurs and other types of individuals and institutions with the skill sets that could then allow them to access funding from, say, a community loan fund, from, say, a micro lending institution, or even a community bank in the long term. But it's another way for nonprofits to really be engaged in this work. One of the things to consider here is that Rising Tide has been doing this for some time, and they have a community business academy in which they effectively outreach considerably and engage a number of low wealth entrepreneurs or prospective entrepreneurs to build their capacities to be small business owners. And they've worked with thousands of such individuals. Really want to talk about Mortar, which is in Cincinnati, Ohio. Founded by these three gentlemen here that you see, young African-American, millennial African-American men in the city of Cincinnati. Cincinnati has among the highest wealth and income inequality along racial terms from black and white in the country. And these gentlemen recognized that there was significant gentrification happening in Cincinnati. And one of the things that they recognize, and the data proves this as well, that one of the best ways to actually reduce the racial wealth gap is around new business formation, new business creation. You could actually look at the Association for Enterprise Opportunity and their data with Black business around this point. But these young men, peers of mine, and Derek Brazil, who was a Bali fellow, really looked at ways to equip entrepreneurs, particularly women of color, people of color in Cincinnati, with entrepreneurial skill sets in which they could develop their own businesses, and not just develop their own businesses, but Mortar takes an approach in which they identify prospective procurement opportunities for the businesses that come out of their program. So that means what they're looking at is, how do we connect, say, a small food business with opportunities to get their catering or get their food business connected to customers. And so they take a really deliberate approach. I also want to highlight Mortar in particular because one of the challenges that Mortar faced or saw with their the small business owners that they were working with, they had a real challenge accessing capital. Mortar was unable or felt it really difficult to connect their entrepreneurs to capital. And so a couple of years ago, Mortar determined that they would create their own fund. They created the Iron Chest Fund, which is a micro lending program that is at Mortar. And so they've really been able to be successful with that. And so it just gives a little bit of highlight in terms of how nonprofits can actually engage in that sort of work. Next slide, please. Then I really want to talk about really quickly about the Baltimore Community Foundation, which is a part of our Foundation Circle program. And one of the things that in Baltimore, 60% African American, 60% low income, 25% poverty rate. And the Community Foundation was able to develop a race equity impact fund in the city of Baltimore that is specifically focused on resourcing African American entrepreneurs and small businesses in the city. This is pretty unique as a community foundation. They put in about $4.5 million of their own dollars and then opened up donor advised fund opportunities for those who wanted to also invest alongside them. And so I just wanted to highlight this is an example of what foundations can do to also build community wealth through their own investment opportunities. Thank you.
Great. And we'll get all of our panelists on screen here. And so I think I'll start with Shranti. And could you talk a little bit, use this term Blexit, which is kind of catchy. What does that mean? And how do you go about organizing for community finance? And you've had to raise over, as I understand, over $1 million. So not the easiest thing to do. So talk a little bit about what that process has been like.
Yeah, definitely. So Blexit, the name actually comes from the concept of us wanting Black people to exit systems of oppression. So that's where the name comes from. And specifically around using community organizing tactics and strategies around community finance, I think there's a couple of things that you can hit on there. Community organizing is all about the utilization of people power and the resources that people bring with them and the resources that are already in community to address systems of oppression and how they show up throughout society or even in institutions. And so when we think about community finance and how organizing can support that, I think it's more so the other way around, of looking at how the principles around community organizing is really about addressing a large system. And so as community finance, we have to think around, well, what is the system that we see in our members or community members facing, and what are innovative products and services that we can create that doesn't replicate those same systems of oppression, isn't extractive, and actually builds towards something different. And part of that is also around education and how the products are different from a community development financial institution than like your traditional larger bank. And even in that sense, there's a lot of great opportunities similar to within community organizing to partner in really strategic and innovative ways while not having, Cliff kind of mentioned this about, we call it not mission creeping, right? So
Mm-hmm.
you have a very set mission. It's actually not on you to do everything, but it is on you to figure out, well, what are those other organizations, at least in your geographic area, that are trying to address some of the same issues that you are, especially with shared values, so that you can partner in a way that offers a suite of options to community members. Because one product isn't going to, it might not drastically change someone's lives. And so being able to offer a full suite that addresses more of a holistic issue is really how those things can work together.
Great, thanks. Ignacio, I wanted to ask you about, and this came up a little bit in the questions from the audience too, but sort of the relationship between community development finance and I'll just call it finance. And one of the pieces of that, obviously, is the Community Investment Act, so that forces banks to, put some money into, or at least encourages them to put money into CDFIs. But could you talk about how that relationship works, and how does community development finance try to, in some ways, make the finance off industry as a whole more democratic, or is that even a possibility?
Sure. So just as a recap, Community Reinvestment Act was created as a result of redlining, mm-hmm. And it encourages banks to invest in the communities in which they do business. It has been around for a while. It has gone through modifications from time to time. In a state like Florida, where philanthropy is young and often puts money to other states from where people come from, not from Florida, there are not a whole lot of sources of capital for community development. Were it not for CRA, banks in Florida, because of CRA, motivated by CRA, are really the drivers behind community development. CRA is about to be looked at again, so they're going through revisions. Part of it is to modernize it, and the banking industry has changed a lot since the first CRA was implemented, or the last revision to CRA. We have now internet banks and things like that, or we have to figure out what to do with those. There are also forces that want to weaken it, and as activists, we should sort of be aware of that. It is an important tool in community development. It isn't the only tool, but CRA is important. And along those lines, I'll echo Cliff's sentiment that the Consumer Financial Protection Bureau, which was sort of the best thing that happened out of the recession for consumers, is right now in trouble. I think we need to make sure that those protections stay, because it is the only government entity that's really looking out for the financial interests of people that transact business with financial institutions. So my banking friends won't like me saying that, but it is super important that we keep the CFPB alive.
Great, thanks. Rodney, you've written about the need to shift where capital is at. Talk a little bit about, what can people who are, on this call, whether they're in nonprofits or philanthropy or just in social movements, do to encourage that shift? What are some policy practices in that regard?
Absolutely. Thanks, Steve. So one of the things, particularly as we're looking at foundations, and I mentioned Baltimore Community Foundation, but I think most of us on the call, and if you're not aware, foundations only required to do 5% contribution, which into to charitable outcomes. That doesn't even fully include grants, though. That includes salaries and all sorts of things. But the bigger pot of money is the 95% of endowments that foundations, particularly private and family foundations, hold. And so really looking at how foundations can best leverage things like program-related investments, which not a lot of foundations do. Program-related investments are actually a really great opportunity to fund the sort of things that, like, Village Financial is doing, where you're leveraging the full economic portfolio of a foundation at its best, and oftentimes can be, depending on how it's structured, can be, if something goes south on that investment as a program-related investment, it can be written off as a grant. And looking at things like mission-related investments, where foundations can specifically invest into the types of things that have been discussed on this webinar, community economic development, really ensuring that communities and individuals that are most impacted by many of the challenges actually have opportunity to guide and own the capital itself. So that is something that I think is really important. And we've talked about CRA. I think right now one of the big things with opportunity zones being rolled out across the country at this moment, which is, I think that the last estimate was about $100 billion in private investment likely to seep in through opportunity zones and opportunity funds, is really for nonprofit institutions to continuously organize, as many are, around how the capital can actually best serve communities that are impacted, so that this billions of dollars do not further increase displacement, but in fact are used to build up the economic power of communities. And so we see a number of nonprofits on the ground doing this, and we also see a number of foundations that are place-based and also national that are looking at ways to leverage their philanthropy and their sort of social capital to ensure that there are ways in which this opportunity zones and opportunity funds are actually opportunities for communities.
Great, thanks. Ignacio, maybe I'll go back to you. I'm kind of curious as to, you guys work a lot of your borrowers, right, are from the nonprofit sector. What sort of, how should nonprofits think of community development financial institutions, and what kind of prep do they need to do, and how can they actually work effectively with institutions like your own?
Sure. So I'll speak about mine, but I think a lot of our peers sort of have the same perspective, so it might be slightly different. We finance projects, but at a core of our DNA is sort of making the nonprofit sector stronger. Florida, for example, has one of the worst housing challenges in the United States. A very large percentage of low-income people are cost burdened, and we do not have a very strong, because of systemic issues and the way that things have been laid out, we don't have a very strong nonprofit housing finance infrastructure system in the state of Florida. That's not to say that there's not some great organizations working, but we see our role not just financing projects, but making sure that when we make a loan to a nonprofit, that nonprofit is going to be stronger because of it at the end, right? That we're not putting a nonprofit in a bad situation, that we're making them better. Our approach involves making sure that we do a lot to try to promote the nonprofit. So for every loan that we make, we put a blurb in our website. We've started doing videos with the goal of promoting their work and ours, and those have been very successful. So it's more than just a borrower-lender relationship. Once we have a nonprofit as a borrower, we are committed to their long-term success, and we'll try to do anything we can to make that happen. And I think you'll find that the Florida Community Loan Fund, most loan funds that are lending to nonprofits, have the same perspective.
Great, thanks. Kranti, I wanted to ask you a question about support and how do you use community finance to actually achieve the sort of the racial equity goals of the association you're working with. And I know that your colleague Malia used to use this, or probably still uses this acronym SKIP. So maybe talk about what that is and what it means.
Yeah, definitely. I think, so the first part of your question, it's one of the things that we tested out this summer when I talked about how do we create products and services that meet people where they're at, was an alternative to payday loans that we call the New Day loan. And so for folks that don't know on the call, a payday loan is a small dollar consumer loan that you can get sometimes up to $1,500 with. Here in Minnesota, the average interest rate is 230%. And that also doesn't include an application fee on top of that. And the reason why they're called payday loans is because you have to pay them back within 2 weeks. And so a lot of folks here in North Minneapolis, there's one main street that actually has 4 of the exact same payday lenders on the same street. And so what we did was, I think there is a, payday loans serve a purpose, right? Like folks are using it because there's a gap in the products and services that make sense that they can access, whether that's that they aren't able to qualify for a loan from a traditional financial institution like a bank or a credit union, or simply because they have trauma around engaging with financial institutions, which is also very valid. And so what we did was a multi-pronged approach of being able to create a product that functions like a payday loan, but actually is termed. So instead of it being paid back in 2 weeks, we offered terms up to 6 months. And so, and again, like we aren't a credit union yet, we're a nonprofit that's developing the credit union. So this is also something that nonprofits, depending on your value system and what lending capacity you have, could be able to do. And so this is, the idea was to really, it was at 0 and 8% for interest rate. And so for us, it was, we weren't making a lot of money on a $500 loan, right? Like similar to other panelists, right? This was more of a value-based product and service. But we do know that if folks are using payday lending services, the fact that that need is there and it sucks that it's extractive, why not just create a product that functions in the same way, doesn't feel unfamiliar to the consumer or the member, and just be able to actually build that that relationship between Village and our community members. And so that's really how we've been pushing ourselves to think about, and again, these ideas are coming from our members. You might have seen on our slide that our approval plan is approved or a plan. And it sounds exactly like it is. The idea is that a lot of folks, we heard from our members in doing outreach and engagement, that the thought of denial was a big part in not even wanting to start the process of accessing certain financial products and services. And so internally, we had a discussion of, if denial is the thing that's going to stop people from even coming into the financial institution, let's take that out of the picture and commit to working with them to either get them approved or set them up on a plan that we're able to check in with them consistently towards reaching their financial goals. Because that's another thing around education, which is really helpful in our sector, is we had a member that came and was requesting the New Day loan when really what she needed was debt consolidation. But we were able to have that conversation with her and actually go with her to her credit union to advocate for her getting a line of credit so that she could pay back that debt. And so some of these things are really around, like, if we as a credit union really care about our members, because those folks that have accounts with credit unions collectively own the institution because it is a financial cooperative, that we also have to push ourselves to be innovative in the way in which we even interact with each other. So yeah, and the acronym, Steve, that you mentioned is SKIP. Yeah. Support, Celebrate, Insulate, and Protect Black Cooperatives. Here in the Twin Cities, we have a really great history with Black cooperatives, and similar to across the country, but that isn't necessarily brought up in the mainstream cooperative landscape for various reasons. And so one of the things that's happening here in the Twin Cities is that there's like a resurgence, a renaissance, if you will, of cooperative entities that currently exist, really talking about diversity, equity, and inclusion and access, as well as Black-led cooperatives really trying to use democratic member-owned entities, co-ops, as a way to work towards equity. And so we really see that in order for those to be sustainable in a capitalistic society, that we need to support, celebrate, insulate, and protect those entities.
Great, thanks, Sharanti. Rodney, I thought I'd ask you a question about, I guess, impact investing and sort of, where do you see, actual shifts of capital occurring? What has been effective? And it seems like, when I think about the work of Bali, there's the large scale impact investing on the one end, and then there's sort of, I want to call it sort of the pre-CDFI work that something like a Rising Tide or Mortar does. So maybe, talk about sort of how you build that ecosystem.
Yeah, thanks for that question, Steve. It's the reality of it, at least the way that I look at it, is that what we consider as mainstream impact investing, when you talk to our Bali fellows and others, particularly those in rural communities, that kind of capital doesn't impact them at all. It doesn't touch them, and so it's largely a conversation that's not even worth having when we look at the mainstream kind of financialization as it looks at impact investing. And so really, when we look at it, it's really thinking about the types of things that have been discussed on the webinar today, when you're talking about building economic power, when you're looking at expanding opportunity, not just opportunity, but really the self-determination within communities to determine their economic fortunes. That is a conversation that impact investing as a mainstream sort of topic of conversation has not gotten to really. And so the way that we look at it is much more specific and niche, and when we're talking about looking at addressing wealth inequality, addressing the racial wealth gap, looking at things from a geographical perspective, when you look at the economic extraction that happens in rural communities in particular, in which you could argue that if folks had this self-determination to actually control the natural resources in place, we wouldn't have these kind of massive inequalities. So that's one thing that we think about very seriously. And so the question then becomes, how do we actually shift capital and power in ways that have been really directly discussed in this webinar? And I know that a number of people are having these conversations that are in attendance for this webinar. And when you look at things like Mortar and Rising Tide, the reality of it is, you take something like the work that Jessica Norwood does with the Runway Project, recognizing that the racial wealth gap deeply impacts new business creation for African Americans. We look at the fact that it costs about $30,000 to start a new business in this country. Where do you get that money from? And so when you look at institutions like Mortar, you look at institutions like Rising Tide, in effect, they're trying to be that friends and family, but from a social capital perspective. And we need to really equate that when we think about addressing wealth and racial inequality in terms of building new businesses. So that's something to really consider. And I think one of the things that we try to advocate for and try to influence is the consideration that in and of itself is an investment. In some ways, the way that, traditional entrepreneurship is seen, it really is a privileged position to be in, right? Because you're accessing, for instance, family capital. You may have educational relationships that allow you to pursue. The reality is that 81% of people who create businesses do not get money from banks, nor do they get it from venture capital. And so where do people get it from? They're getting it from maxing out credit cards. They're getting it from friends with family. There's all sorts of ways that they're oftentimes getting it, as was just articulated, from these predatory loans. And so how do we create different types of ways for folks to engage and pursue these activities? And this is really a call, I think, for foundations in particular that are charged in many ways to uplift the social good. And I think this is where a lot of the innovation can happen in the nonprofit sector in terms of really creating different ways and really being focused everything that was discussed in this webinar is exactly what we need to do. The question is, how do we get out of the mindset of, oftentimes when I'm in a conversation with impact investing, conversations, it's people get excited about like the scale of it. Trillions of dollars will be, exchanged hands over generations. And the questions that we need to ask ourselves are like, what kind of capital will actually emerge in the communities that like Village Financial is working in? Right? Like that is the question. Mm-hmm. And impact investing by and large doesn't address that. And so what we focus on at Bali and what's been discussed on this webinar is really how do we direct capital into those types of solutions and acknowledge to the point that, yes, Black cooperatives and other things have existed for a long time. This is not new. It's just that mainstream capital has not visited for all sorts of reasons that we can get into it at another time. But we need to figure out those ways. And I think we see a lot of things happening across the country that really looks at how to address these issues.
Great. And that really transitions well into an audience question, which is really sort of, how do you develop that initial capital and when you don't have a track record? And Shanti, and I know you were talking a little bit about that in terms of developing products even before you open, which seems like a fairly brilliant strategy to me. But Ignacio, you also were involved with the startup way back. So, it can seem pretty daunting when you don't have the track record and you're just trying to get off the ground. Any thoughts?
Yeah, definitely. I think a little bit about our story when community said, hey, we want a Black-led financial institution, and we had to go figure out what that meant and what kind of financial institution is that. We had a local family foundation actually fund us to start doing this work, the J. and Rose Phillips Family Foundation, that specifically has a portfolio that's centered geographically around North Minneapolis. And so when we think of like nonprofits and how they can even start to do like research and investigation around what some of these community-based solutions are, the funding for that is, like you mentioned, essential to even be able to properly compensate people for doing this work, which is what we see happen a lot of times, not only in nonprofits, but in grassroots organizing of people doing really great work, but not having the capacity to really operate the way in which they would like. We actually, from starting our, naming the credit union to submitting the application, it was around 18 months of work, and a credit union normally takes 3 to 5 years to start up and go through that process. And when you pair our grassroots organizing strategies with the fact that we had a local family foundation that was really aligned in our mission and values, and we're able to be comfortable with supporting Black leadership unapologetically and being able to focus those funds, it was really helpful in us being where we are today.
Great, thanks.
And I think in our case, most CDFIs are going to need 3 types of capital, sort of lending capital or borrowed money, PRIs, investments from banks. They need operating capital early on because you're not at a scale yet where you can pay for people. And then the most important part is sort of the equity capital that's going to allow you to bring in other sources. Without making a very long story, we were very fortunate in our early years that the Jesse Ball DuPont Fund, a Jacksonville-based foundation, put in both operating support and equity capital. It was, in retrospect, it was small, about $250,000 in equity capital, but it was incredibly important. So CDFIs don't necessarily grow super fast, but once you get to a certain level, you reach a scale at which you can grow pretty well. And the first few years are difficult. The first 10 years, you're going to have moderate growth. But I always think of the first capital is essential, but I always think about these institutions that we're forming as being here well after we're gone. So I'm okay to be patient in building the capital as long as that capital is organized in the right way so it can have a lasting impact. And I think most of us approach it that way.
Great. So another question that came from the audience was, I'll call this standard community development finance questions, but things like what is required from borrowers in terms of business plans, loan loss rates, that kind of thing. How do you, I guess, another way of thinking of this less technically is how do you balance the economic margin that you need to achieve, while maintaining the mission?
So let me see how I answer that question. I think I'm not sure if the question is what are the basic requirements to apply for a loan, or what are the loan terms and things like that.
I think more the former than the latter. Yeah, I don't think they're asking about interest rates per se. Yeah.
So in our case, we finance nonprofits in the whole range of development. So from very sophisticated nonprofits that have established business plans and audited financial statements to nonprofits that are just sort of getting off the ground. We typically ask for at least 2 years of being in business. We very much recommend, actually don't recommend, we do not fund operating, we do not lend for operations. It's just not a good idea. There are other sources for that, and you don't want to start your life as a nonprofit, or you don't want to work out of trouble by borrowing if you have a cash flow need, in most cases. But within that, we pride ourselves in trying to be as flexible as we can, recognizing that at the end we still expect repayments for every loan that we make. So we use the same tools that a bank does, but we are able to, because we work with nonprofits so closely, we're able to adapt those to make loans where a bank typically wouldn't. One very good example is that banks often have a difficult time projecting into the future the likelihood of grant funding in a pro forma financial statement. Meaning, we see this grants that came in X and Y, Z year. We're not sure that those are going to come in the future. We have no way of knowing. In our case, we have a pretty good feel of and understand that sometimes nonprofits bring in more money than other years. So we have a way to incorporating those nuances that are unique to nonprofits into our analysis in a way that more often than not makes a loan possible.
Great. So thanks. So we got a question about giving circles, and that has been a widening strategy for sometimes, I guess, sort of this pre-CDFI level maybe, but I was wondering if any of you have been working with giving circles, see them, their how their importance might grow over time.
I mean, I'm happy to try to answer that, Steve, if that makes sense. So one of the things that in terms of giving circles, just different types of ways of leveraging philanthropic capital to move these things along. I mean, giving circles definitely are one thing that I think we're seeing as an opportunity. Donor advised funds, which is not exactly a giving circle, but a different type of way of giving versus a foundation. Donor advised funds was sort of the principal business model for a lot of community foundations, but also a lot of commercial interests like Fidelity and others crossed $110 billion last year. And so it's it's pretty large industry, as it were. And so you're seeing a number of, particularly in the mainstream impact investing space, you're seeing a number of institutions, say like Impact Assets, for example, that manages about $500 million in donor advised funds specifically to make those investments into, quote unquote, impact investments. And I think one of the things that's really important, we look at giving circles, giving circles, donor advised funds, really can fill the role, particularly in communities that have been systemically marginalized, of like what will be traditionally friends and family capital. And the reality of it is, if you look at the U.S., friends and family in the commercial space is about $60 billion. So it's a lot of money that historically marginalized communities don't have access to. And so how do you leverage philanthropy in more creative ways is one thing. And I also would note, too, that community financial development institutions, CDFIs, really have a really difficult job at hand because, you know, the business model is really hard. And as it's just kind of articulated, trying to both match mission and also be a sustainable enterprise and of yourself. And I think one thing as a nonprofit sector, hopefully this is not too controversial, but one of the things that we kind of take for face value, that the 5% payout for foundations has to be that forever. That is not the case. That is actually a more recent introduction, I think in the 70s, in which we create that legislation and regulation, and that foundations are required to, at the floor, contribute 5%. So one thing I would encourage us all to think about more creatively is that how do we actually have policies in place that will allow philanthropy to be more creatively disrupted to move along the economic interests of economically marginalized communities. And when I say that, that specifically means, do we need to have policies that require foundations to actually put out more capital into community economic development, for example? So I just want to encourage that, because I've seen, because a number of us on this webinar and the audience, over the years, whenever there's something that could be negative for foundations, we oftentimes actually fall in line to support as a sector. And really, we should be thinking more creatively about what are kind of policies that could enable, say, donor advised funds, philanthropy, giving circles to really be able to be critical ingredients for advancing community economic development.
Great, thanks, Rodney. So another question that came up, so I'm not sure, some of you may be involved or connected to, Rodney, you know Brendan Martin from the working world, so there's a whole effort to build a platform of what are known as, I guess, non-extractive loan funds that support, you know, especially worker cooperatives, other types of community development, you know, where they basically take a royalty position as opposed to charging interest on a loan. So, you know, where do you see that effort at, and what role do you see that playing in helping achieve this kind of a shift?
And so, Steve, is the question really around like the revenue share as an option, or just broader kind of? Well,
both the revenue share as an option, as a strategy, as well as you know, what platforms need to be developed in that area.
Yeah, so I think this is a perfect example of like a really innovative nonprofit response to a systemic challenge, because a lot of, at least when Brendan and I have spoken about this, the reality of it is that you have a number of smaller institutions raising capital around community economic development, particularly around worker ownership. And the traditional financial markets don't really work that way. So if you're trying to, for example, a pension fund in Pennsylvania or Maryland, they want to invest in something no less than $25, $50 billion. That's how they operate. And so the idea that we could be a cooperative of cooperatives to bring in larger dollars that can then be mutually advanced, I think is a wonderful idea. Obviously, when you look at revenue share, that as one tool is I think really great. I think there's other tools that we can explore, but revenue sharing, so looking at it from a non-extractive position is something that we obviously need to be thinking about. And so I think that has real legs. I do think that, of course, revenue share still has its limitations in the same ways that debt has its limitations, in the same ways that traditional equity investment has its limitations. That's not to suggest that we shouldn't be doing more of this, but I think what Brendan and Working World and others that are part of the finance cooperative are really pushing for is different ways of thinking about the relationship between capital to people, right? This idea that we can unpack capital supremacy and actually have a different way of looking at it is, and again, I keep saying different, but a non-mainstream approach to looking at capital. And by the way, revenue share is something that happens in venture capital now, right? It's not just limited to, worker ownership. Even in the VC sector industry, people are seeing that equity investments and debt, there have to be different models. So I'm happy to see that it's actually happening in our space as well.
Great, thanks, Rodney. So this is another question from the audience. The question is kind of both in some ways basic and in some ways pretty profound. It's asking, how do credit unions function, and how do they provide actually greater control over capital for people? So Shranti, you're developing a credit union. How do you see its role being different than a bank in maintaining that mission orientation? You still have to have loans, you still have to get them paid back. I mean, there's some elements that are the same, right?
Yeah, definitely. So I think the easy way to talk about the difference between banks and credit unions is around like money circulation. And so one thing in your traditional bank, there are shareholders. And so when money is put into a credit union through accounts, that money can, one, just be traded on the stock market, or it could even, like when there's profit, when the business makes a profit, the money and those profits will go upward towards the shareholders. And in credit unions, the difference is really around that community ownership aspect. And so I mentioned this a little bit earlier, but when you open up an account at a credit union, there's a membership fee that you're asked to put forward, and that really is giving you ownership into the credit union. And so we say that in cooperatives across the field, it's one member, one vote for most co-ops. And so that means that when you're a member owner of a credit union, that when we're voting for our leadership, so like the board of directors, that the board of directors is actually coming from the membership, as well as the members get to vote on that leadership. And the difference in the money circulation aspect is that instead of money going, when there's a profit made, instead of money going upward to shareholders, it actually gets recirculated within the community. And so one thing I like to tell folks when they're thinking generally about whether a bank or a credit union, I like to have folks think about what they would like their money to do while it's theoretically sitting in a financial institution. And with credit unions, and this is similar, a great like language thing that we use at Village, that instead of it being that you need to repay your loans, which people do need to repay their loans, but the language more so being that every time you make a payment on your loan, that's more capital that your neighbor can actually access from the financial institution too. And so we all on this panel and other folks in our industry have been talking somewhat maybe around like an individual and their relationship to money, right? And so if we're seeing financial institutions not necessarily as building wealth, but just as transactional between there's a consumer or a member coming just for a service, and it doesn't actually really hit home that idea of the money that's in this credit union is actually shared resources. And so that's really what we're wanting to convey as like the difference between ourselves and banks generally. And then even pushing, being able to set that standard for other credit unions, not only in the state of Minnesota, but nationally around what does it mean to actually have that membership experience and member engagement in a way that your members are informed and active so that they can actually help the larger institution continue to be value-based as well.
Great, thanks, Shanti. So I'll ask one quick last question, then we need to wrap up. So there was a question raised about the role of faith communities and community finance, and obviously, there's a huge story there, but does anybody want to share a quick story on that?
Well, I can start. I have worked for 2 financial institutions in my life. Both of them were started by nuns. So the farm worker credit union that I worked at was started by nuns, and the Florida Community Loan Fund was started by a large group of people that were led by Sister Mary Heiser, who people refer to as Organizer Heiser. And she really got a very diverse group of people together around the same idea. As a result of that, our first debt capital, the first loans to the loan fund to be able to make loans to others, came from religious communities, from nuns, from orders of nuns that were pooling their money and taking a very decided counterpoint to the disinvestment movement from South Africa, and instead being proactive about where they were investing, and found loan funds and other CDFIs as a way to do that. And they have played a crucial role in the development of the CDFI industry, not just for the loan fund. There's many instances throughout the nation where nuns and other religious faiths have done that. One thing that Sister Mary liked to do is to say that she got the females in the Catholic Church to come in, and then she worked on the male side. So after that, she went to all the bishops in the state of Florida and encouraged them to invest. And it was hard to say no to Sister Mary. So now we have investments from a much broader range of religious institutions, and they don't represent a large portion of our total assets, but it's an incredibly important portion of our assets because they're probably the ones that are most aligned with the mission we want to pursue. We know when we get bank dollars, they want us to do good things. They're also meeting a CRA requirement. But when we have a dollar from a religious organization, we know that they want us to create impact with that. So it kind of keeps us grounded.
Great. Well, we are at time. Thanks, Ignacio. And so I want to thank all of our panelists, Rodney Foxworth from Bali, Sharanti Tilaka from Village Financial Capital in Minneapolis, Ignacio Estevan from Florida Community Loan Fund. And thanks to all of you for joining us. We will be following up by email with some additional information and, of course, a link to the slides in the webinar. So thanks again.
Thank you, everyone.
Thank you.
Thanks, Steve.